Imagine you attend a dinner party and announce that you are considering investing in the stock market. The responses are polite but mixed. Some will warn you about volatility. Others will remind you of 2008. A few will tell you about their cousin who lost money on tech stocks. Now imagine you announce that you are considering buying an investment property. The responses are entirely different. People will nod approvingly. They will tell you that real estate is the path to wealth. They will quote the old saying about God not making more land. They will point to their neighbor who bought a duplex in 2010 and is now retired. The cultural assumption that real estate is a superior investment is so deeply embedded that questioning it feels almost unpatriotic. But when you actually run the numbers, when you strip away the emotional narratives and the tax myths and the survivorship bias, a different story emerges. For most people in most markets over most time periods, residential real estate has been a mediocre investment at best, and for many, it has been a wealth destroyer disguised as an asset. The math is uncomfortable, but the math is also clear. Real estate is not a good investment. It is a lifestyle choice that people mistake for an investment because the alternatives, stocks, bonds, businesses, are less tangible and less culturally celebrated. To make this case, we have to first define what we mean by a good investment. A good investment is something that generates a return greater than its risk-adjusted opportunity cost. In other words, if you can earn 7% per year in a diversified stock portfolio with moderate risk, then any other investment should offer either a higher expected return to compensate for additional risk, or a similar return with lower risk, or some unique non-financial benefit that justifies a lower return. When you apply this standard to residential real estate, the performance is disappointing. The long-term real, inflation-adjusted, return on residential real estate in the United States from 1890 to 2020 was approximately 0 to 1% per year. That is not a typo. Over more than a century, the average home appreciated at roughly the same rate as inflation. The famous run-up in home prices from 1995 to 2006 was a historic anomaly, not a trend. And the run-up from 2012 to 2022 was driven by interest rates falling to 5,000-year lows, a one-time event that cannot be repeated because rates cannot go below zero in any meaningful way for long. The primary driver of wealth in homeownership has not been appreciation. It has been leverage, forced savings, and the fact that you have to live somewhere. Those are real benefits, but they are not investment returns in the way most people imagine. Let us start with the leverage argument, because it is the most common defense of real estate as an investment. The claim is that you can control a large asset with a small amount of your own money, and if the asset appreciates, your return on that small amount is magnified. If you put $20,000 down on a $200,000 property and the property appreciates 5% in a year, that is $10,000 of gain on your $20,000 investment, a 50% return. That sounds incredible. But the math omits several critical details. First, the 5% appreciation is not guaranteed and has been historically rare. At the long-term average appreciation of 0 to 1% real, the $20,000 down payment generates $200 to $2,000 of annual gain, a 1 to 10% return, not 50%. Second, the leverage costs money. You are paying interest on the $180,000 you borrowed. At a 6% interest rate, that is $10,800 per year in interest alone. Your $10,000 of gain at 5% appreciation is completely wiped out by interest. You actually lose money. Third, you have property taxes, insurance, maintenance, and potentially property management fees. These costs typically run 2 to 4% of the property value per year. At $200,000, that is $4,000 to $8,000 annually. Add that to the interest, and your leverage is destroying wealth, not creating it. The only way leverage works in your favor is if appreciation is high enough to outrun the carrying costs. In most markets most years, it is not. Now compare this to investing in the stock market. With $20,000, you can buy a diversified portfolio of global stocks with no leverage, no interest payments, no property taxes, no maintenance, and no management fees beyond the tiny expense ratio of an index fund. Your expected long-term real return is about 6 to 7% per year. On $20,000, that is about $1,200 to $1,400 per year in real gain, with no work, no tenants, no toilets leaking at 2 in the morning. You can reinvest those gains and compound them tax efficiently. You can sell small portions whenever you need cash. You can hold the investment for decades without ever thinking about it. The real estate investor, by contrast, has a second job. They are managing tenants, repairs, vacancies, evictions, tax filings, and legal liabilities. If they pay a property manager, that eats another 8 to 12% of rental income. If they do it themselves, they are trading their time, which has value, for a return that is often lower than what they could earn with no effort in the stock market. The second major myth about real estate is that it is a hedge against inflation. This belief comes from the observation that home prices and rents tend to rise with inflation over very long periods. But stocks also rise with inflation over long periods, and they have historically risen much more. More importantly, the inflation hedging quality of real estate is not free. When inflation rises, mortgage interest rates typically rise as well, which reduces the affordability of homes and can actually depress prices in the short to medium term. The homeowner with a fixed-rate mortgage benefits from inflation because they pay back the loan with cheaper dollars. That is a genuine benefit. But that benefit is not an investment return. It is a transfer from the lender to the borrower, and the lender, a bank, has priced that risk into the interest rate they charge. The inflation hedge argument is often overstated because it ignores that other assets, like Treasury inflation-protected securities or a simple stock portfolio, provide similar inflation protection without the illiquidity and transaction costs of real estate. The third myth is that real estate is a tangible asset that you can see and touch, unlike a stock certificate which feels abstract. This psychological comfort is real, but it is not a financial return. In fact, the tangibility of real estate leads many investors to hold concentrated, undiversified positions that are far riskier than they realize. A single property in a single neighborhood in a single city is subject to idiosyncratic risks that a diversified stock portfolio avoids entirely. The local factory could close. The school district could decline. A new highway could reroute traffic away from your street. A flood could damage your property. A bad tenant could destroy your home. These risks are not theoretical. They happen every day to real estate investors who thought they were being safe by buying something tangible. A stock index fund, by contrast, owns thousands of companies across dozens of countries. If one company fails, the impact is negligible. If one sector collapses, the rest of the portfolio continues earning. The tangible asset is actually the riskier asset because it cannot diversify. Let us look at the specific math of a typical rental property. Suppose you buy a $250,000 single-family home with a 20% down payment of $50,000. Your mortgage is $200,000 at 6.5% interest, a typical rate as of this writing. Your monthly principal and interest payment is approximately $1,264. Add property taxes at 1.2% annually, that is $250 per month. Add insurance at $100 per month. Add maintenance at 1% of property value per year, that is $208 per month. Your total monthly carrying cost before any vacancy or capital improvements is approximately $1,822. You rent the property for $2,000 per month, which is a reasonable gross yield of 9.6% annually on the property value. Your net operating income before mortgage is the $2,000 rent minus property taxes, insurance, and maintenance, which is $1,442. Subtract your mortgage payment of $1,264, and your monthly cash flow is $178. On a $50,000 down payment, that is an annual cash-on-cash return of 4.3%, before accounting for vacancies, repairs, tenant turnover, legal costs, and your own time. That 4.3% is comparable to a high-yield savings account, but with far more risk and work. Now add an appreciation, which we have assumed at zero real. But let us be optimistic and assume 3% nominal appreciation. That is $7,500 per year in paper gains on the $250,000 property. Your total return is the 4.3% cash flow plus the 3% appreciation, about 7.3% nominal, or roughly 4.3 to 5.3% real after inflation. That is not terrible. But it is also not better than the long-term real return of the stock market, which has averaged 6 to 7% real with no work, no tenants, no toilets, and perfect liquidity. And that calculation assumes no vacancies, no major repairs, no bad tenants, no rent control, and no periods where the property cannot be rented. In the real world, vacancies and capital expenditures will eat at least 1 to 2 percentage points off that return. You are now down to 3 to 4% real return for a part-time job that exposes you to catastrophic downside risk. That is not a good investment. That is a hobby that sometimes pays for itself. The tax advantages of real estate are often cited as the reason the math works even when the raw numbers look bad. Depreciation, the ability to deduct a paper loss against rental income, and the ability to defer capital gains through a 1031 exchange are real benefits. But these benefits are often misunderstood. Depreciation is not free money. It reduces your cost basis in the property, which increases your capital gains tax when you eventually sell, unless you die and your heirs receive a step up in basis, or you do endless 1031 exchanges until death. The tax code does favor real estate investors over stock investors in some ways, but the gap is not as large as real estate promoters claim. Stock investors pay preferential long-term capital gains rates on gains, and they have no depreciation recapture. They can also defer gains by simply not selling, and they pay no tax at all on unrealized gains. The real tax advantage of real estate is that you can deduct mortgage interest and property taxes against rental income, but those are real expenses, not tax games. The more accurate way to think about real estate taxes is that they turn a mediocre investment into a slightly less mediocre investment. They do not turn a bad investment into a good one. The comparison becomes even more stark when you consider the difference between primary residence and investment property. Most people who think of real estate as a good investment are thinking of their own home. The math on a primary residence is different because you have to live somewhere. You are going to pay for housing whether you own or rent. The question is whether owning is cheaper than renting over your expected holding period, and whether the non-financial benefits of ownership justify any extra cost. That is a valid question. But treating your home as an investment is a mistake. A home is a consumption good that may or may not appreciate. It generates no rental income. It costs money every month in taxes, insurance, maintenance, and interest. The imputed rent, the rent you would pay if you did not own, is a benefit, but that benefit exists whether the home appreciates or not. The financial benefit of homeownership comes from locking in your housing costs and building equity through mortgage principal payments, not from price appreciation. When you run the numbers honestly, owning a home is often financially superior to renting over long time horizons, but not because homes are great investments. It is because renting exposes you to rent inflation and the hassle of moving, while owning provides stability and forced savings. That is not the same as earning a high return on capital. The people who truly make money in real estate are not the ones who buy a single-family home and hope it goes up. The people who make money are the ones who treat real estate as a business, who buy at deep discounts, who add value through renovations, who manage properties efficiently, who negotiate favorable financing, and who scale to multiple units so that fixed costs are spread across more doors. That is a job, not a passive investment. It requires skills in construction, property management, finance, law, and negotiation. The people who succeed at that job earn a return that compensates them for their labor and their risk. That return may be higher than the stock market, or it may not. But it is not a passive return on capital. It is an active return on labor and expertise. For the vast majority of people who do not have those skills or that time, buying a rental property is a recipe for mediocrity or disaster. They would be better off putting their money in the stock market and focusing on their career, where their comparative advantage lies. The historical evidence is damning. A study by economists at the Federal Reserve Bank of San Francisco examined the long-term returns of residential real estate versus stocks in 16 developed countries from 1870 to 2015. They found that housing provided a real return of about 7% per year, but that number includes the imputed rent that homeowners pay to themselves. The price appreciation component, the part that investors actually care about, was only about 1% real. Stocks, by contrast, provided a total real return of about 8% per year, almost all from price appreciation and dividends. In other words, the only reason housing returns look comparable to stocks is because you count the rent you save by owning, which is a consumption benefit, not an investment return. If you own a rental property, you do get actual rent, but then you have to subtract the costs of management, vacancies, maintenance, and the risk of non-payment. After those costs, the average rental property has barely kept up with inflation. The stock market has crushed it. There is a reason why university endowments and pension funds allocate only a small percentage of their portfolios to direct real estate, and when they do, they focus on commercial real estate, not residential. The reason is that residential real estate is a poor investment for large institutional investors, just as it is for small individual investors. The returns are low, the risks are idiosyncratic, the transaction costs are high, and the liquidity is terrible. The institutions that do invest in real estate are often investing in real estate investment trusts, or REITs, which are publicly traded stocks that own real estate. And REITs have historically provided returns similar to the broader stock market, which is to say, better than direct residential real estate, with far lower hassle. If you want real estate exposure in your portfolio, buy a REIT ETF. You will get the diversification, the liquidity, and the professional management. You will not get the tenants, the toilets, or the tax complications. And you will likely earn a higher return for less work. The calm closing thought is this: real estate is not a bad thing to own. A primary residence provides stability, pride of ownership, and a forced savings mechanism that works for many people. A rental property can be a good business for someone with the right skills and temperament. But real estate is not a good investment in the sense that most people mean. It does not generate high returns on capital without significant labor and risk. It does not reliably beat the stock market. It does not provide safety through tangibility, it provides concentration risk. The cultural narrative that real estate is the path to wealth is a narrative, not a mathematical fact. The people who tell you otherwise are often trying to sell you something: a seminar, a course, a coaching program, or a property. The math does not lie. But it does require you to look past the stories you have been told and calculate the real numbers for yourself.